Welcome back to CPA Mastery. In this lesson we focus on the tax treatment of life insurance proceeds. Life insurance policies provide financial protection by paying a death benefit to a beneficiary when the insured person dies. Under the tax law, these payments usually receive favorable treatment. The general rule is that life insurance proceeds received because of the insured person's death are excluded from gross income. However, there are important exceptions that the CPA exam sometimes tests. In particular, the transfer for value rule can cause part of the proceeds to become taxable. By the end of this lesson you should understand the general exclusion rule, the transfer for value exception, and how to analyze life insurance questions on the REG exam. In this lesson we have three main objectives. First, we will explain how life insurance policies work and why they are relevant for tax purposes. Second, we will review the general rule that life insurance proceeds received because of death are excluded from gross income. Finally, we will discuss the transfer for value rule, which is an important exception that may cause life insurance proceeds to become partially taxable. Life insurance is a contract between an individual and an insurance company. The policyholder pays premiums, and the insurance company agrees to pay a benefit when the insured person dies. The person who receives the benefit is called the beneficiary. The payment is known as the death benefit. Because these payments can be significant, the tax treatment of life insurance proceeds is an important concept tested on the CPA exam. The general tax rule is that life insurance proceeds received because of the insured person's death are excluded from gross income. This means the beneficiary typically does not pay income tax on the death benefit received from the insurance company. The reason for this rule is that life insurance is designed to provide financial protection to surviving family members, and Congress has decided that these benefits should generally not be taxed. When a beneficiary receives a life insurance death benefit, the payment is usually excluded from gross income. This means the beneficiary does not report the amount as taxable income on their tax return. For the CPA exam, it is important to remember that the exclusion applies specifically to proceeds received because of the insured person's death. The transfer for value rule is an important exception to the general exclusion for life insurance proceeds. If a life insurance policy is transferred to another person in exchange for something of value, the favorable tax treatment may be lost. When this rule applies, part of the life insurance proceeds may become taxable income. Suppose a taxpayer receives a $100,000 life insurance death benefit after the insured person dies. Under the general rule, this payment is excluded from gross income. The beneficiary receives the full amount without paying federal income tax on the proceeds. Consider a CPA exam question where a life insurance policy was sold to another party before the insured person died. Because the policy was transferred for value, the tax treatment may change. The beneficiary may have to include part of the proceeds in gross income. When analyzing life insurance questions on the CPA exam, always check how the policy was acquired. If the beneficiary obtained the policy through purchase or transfer for value, the favorable tax treatment may not fully apply. If the policy was simply held until death without being transferred, the proceeds are generally excluded from income. Life insurance death benefits received because of the insured person's death are generally excluded from gross income. However, the transfer for value rule may cause part of the proceeds to become taxable if the policy was transferred in exchange for value. For the CPA exam, remember the general rule of exclusion and always check whether the transfer for value exception applies.